Like if you make a perfect store value, it would mean that that thing, this one unit, is now pinned to all other prices, right? Forward in time. So that thing can forever buy X loaves of bread or whatever. Well, great. You just killed markets. That is literally, you're describing price fixing. It's like, it is not a goal.
Deal that wheat should be this and shoes should be this and the ratio should be fixed at all times. So
yeah, like that. Great, Stalin.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com. Now, on to today's episode.
Hello, everyone, and welcome to the Gold Exchange Podcast. My name is Dixon Buchanan. I am the Vice President of Marketing here at Monetary Metals, and I'll be hosting today's episode. I'm joined, as always, with the founder and CEO of Monetary Metals, Keith Weimer. We are super excited about today's episode because we have a very special guest lined up for the show today. And I really mean that. This person is special. If you've spent any time in the wide realm of Twitterdom, you'll know that his presence casts a long, dark shadow over those who foolishly chase bull markets, tout speculative assets, and dare to utter half-baked financial sophisms in his presence. I'm referring, of course, to Travis Kimmel, but I realize you may not know him by his proper name. You may actually know him by one of his many online aliases. This is Travis, aka the Dollar Fatalist, aka the Wizard of Web 1.0, Travis, aka the Crusher of cryptocurrency dreams, and my personal favorite, the illustrious BearLord. So, Sir BearLord, it is with great respect that Keith and I welcome you on our show today.
Wow, that is the best intro I've ever received. So thanks for having me.
Yeah, let me just start by saying, if you're on Twitter and you're not following at Colorado Travis, that's Colorado spelled just like the state, go ahead, press pause right now, go onto Twitter, follow him, and trust me, you will be glad that you did. Really, really good takes on macro markets, business, the occasional, philosophy, kind of cultural moment tweet. It's one of those rare accounts, in my opinion, that makes you think and laugh, often in equal proportion. So do yourself a favor, go follow Twitter. We'll link to his account in the show notes. But let's start, actually, Travis, if you don't mind, by giving us a little bit of your backstory, how you became interested in finance, and the origins of BearLord.
Yeah. So I come from the tech world. I was a programmer for a little while, then got into managing software teams, and then eventually started a company it was an analytics company with a friend of mine, Ben. I was one of the co-founders. And was the CEO of that for about 4.5 years. And then we sold that. And I'm now, still in the tech world. My interest in financial markets is kind of twofold. One, I think one of the things I find really enjoyable is it's sort of this infinite game, right? Like there's always more that you can learn about finance. It's very, the breadth is just so intense. And I dig that. So that part's fun. And then I find it to be, I like the sort of enforced discipline of finance. I mean, risk management, like the feedback loop is ultimately just sort of baked in. I think that part's really fun. The people who are in it have kind of an edge to them as a result of that. And it's just a good crowd. I think one of the things that's really interesting about finance is a lot of the stuff that gives that edge is actually kind of boring. Like it's really boring. I mean, like a lot of the world is just sort of like understanding balance sheets, which I think a lot of people don't. It's not really an area a lot of people want to dig in on. But if you can develop a fascination for that, it becomes really powerful. So I've been trying to do that.
I wrote a article back in maybe it was February 2015, January, February, right after the Swiss franc busted its peg against the euro. The Swiss National Bank lost something like 20% of Swiss annual GDP in a millisecond. And then the entire Swiss yield curve out to 30-year maturity plunged below zero, went negative.
Yeah.
And I wrote a really long article. I want to say it was 5,000-6,000 words, essentially arguing the Swiss, not essentially, arguing the Swiss franc was going to collapse, although nobody knows when. It was, it was a balance sheet flows kind of analysis, like all the really boring stuff.
Yeah.
It turned out to be such a hot potato. It was so controversial, and people either hated me or loved me based on the fiery conclusion. And nobody really seemed to have done the reading of like what I said. It was a pretty boring, something an accountant or a finance professor could like maybe. And that stirred things up to such a great degree that I don't have any regrets doing it, but it was an interesting experience.
Yeah. Yeah. I think, finance markets are also like highly emotional, and the emotional part is sort of the opposite of what you actually get paid for. So that's kind of a fun dynamic.
Hey, don't be dissing my asset now.
No,
I'm gonna have
no, you know what?
Oh, mad.
I'm actually a fan of that aspect of it. I think, the longer you sort of try to play in finance markets, the more humbling it is, really. I mean, it's just hard, like a lot of this stuff, especially like you said, you can have these theses which you think are kind of bulletproof. Like you're kicking them around and you're like, it has to play out at some point. And it can be years, and you're just sort of sitting there looking the fool for years. And so it's sort of, I don't know, it's a test of your mettle or something as well. I mean, I think the dollar bulls went through that recently, right? Where like the dollar is just falling and falling. And it's like, yeah, but the way the system works, like that thing's coming back. It's coming back at some point. And, we're sitting there floating around 88 or whatever it was at in Dixie for years, or for, months of last summer. And then, the inevitable always comes. It's hard to fight gravity.
Here we are at 104. I must be a glutton for punishment, because I love to really promote the thesis at the time when the world seems to be going against it.
Same. I think that's why we're friends.
Most of my first wave of Bitcoin criticisms were during 2017 while it was skyrocketing.
Yeah, totally.
It turns out I wrote the last one, and I decided for other reasons, okay, enough here. I've kicked this thing to death. Almost perfectly top-ticked it in December of 2017. Completely unknown. In every one of those articles, I was like, where's the Bitcoin price going to go next? I don't know, and neither does anybody else. Neither does that guru that you're paying to tell you where it's going to go. He doesn't know either.
Yeah.
And then, recently, the bond bear case, inflation and rising interest rates and all that. And my thesis for a very long time has been that the mega trend is falling. And every once in a while, I get this troll on my Twitter. And he's like, "You're still wrong, after all these months." And it's like, how many times do I have to explain to you? This isn't a trade. I'm not a trading service. I'm not saying go long treasuries with leverage. I'm saying, here's the macro dynamic. Here's how the engine's turning, and everybody can pretend it's going to go the other way. And there's a certain amount of, slop or flex in the system, but this is going to come back with evidence. You mark my words. And
I mean, any kind of macro trading, anything macro with leverage is like, it's dicey business.
That's right.
Yeah.
Keynes was not right about a lot of things, but one of the things he was right about was markets can stay irrational longer than you can stay solvent.
Way longer. Yeah. I mean, especially times like these, you see these moves are whipping around. It's like leverage just blows people out, even if they end up being right.
Talking about whipping around, a friend of mine is a commodities broker in Chicago, mostly focusing on Eurodollars, which doesn't mean the same thing as the Eurodollar milkshake, Jeff Snyder thing on Twitter. He's just in the interest rate future, what they call the Eurodollar contract. But a buddy of his is in Energy Pit, and there's action on $50 nat gas, and what did he tell me? Like for January, nat gas is like, what is it right now? $12 or something. I don't follow it real closely.
Depends on where.
And there's action on $500 crude futures.
Whoa, that's wild.
500. And I'm like, just imagine what would happen. And this is going to kill people if this happens.
Totally. I mean, it already is, you're seeing these the retailers coming in with these just horrific earnings reports. I mean, like the consumer is kind of dead, and it looks like the solution to that is everybody's reaching for either the credit card at these nutty rates or these these like buy now pay later shadow leverage businesses, which are allowing people to you can like finance your pizza order. I mean, this stuff is just so dangerous.
Oh my God.
It's absurd, right? Like
you
you do these checkouts.
Yeah,
You're like ordering lunch. It's like, hey, you want to pay for this over the next 3 weeks? I'm like, what? Why are people doing that? Oh man,
rates are only nutty if you actually repay.
Yeah, right.
Or it's just purely not. It's not real. It's nominal.
Yeah, totally. Yeah, we're getting into an interesting spot here. I mean, one of the things, to circle back to the bond thing, to my mind, I get the same Twitter trolls. It's like, is that still alive? Yeah, it's very much alive. I mean, where's growth going to come from? I mean, I don't quite know how the path that we're going to take. I have no idea. But I know that that we go into these moments where people just sort of like hate cash. And if you think about that, hating cash is the same. It's the same dynamic in play when you lever up, right? People are just trimming their buffer for being wrong down to this little nub. And then with these financing services going even deeper than that, right? And I think those kind of dynamics just don't typically, when the consumer's that hard pressed, and we've been, we're in this sort of cash bonanza phase here in COVID, where people got a little nihilistic, and when there's death in the air, this is like a historical phenomenon. When there's death in the air, which there was a little bit of, people just sort of live for today, and so it pushed this wild spending boom into a supply shock. And I just don't know that anyone is really calibrating what it's going to be like to mean revert from that, right? That's pretty brutal. What's your read on that?
Well, I've been writing a lot about what I call lockdown whiplash.
Yeah.
Had the lockdown, which, people think like the economy and the supply chain is like a VCR, just press pause.
Yeah.
And, you can go to the bathroom, you get on a call with your friend, and, 2 hours later you hit unpause and everything's fine.
Yeah.
And the real world keeps moving forward, and everybody has to keep paying, rent on their building, and has to keep paying the debt service on the ships and the trucks and all those things. And some of those people go away. A lot of the ships were abandoned or otherwise shut down in all the wrong locations.
Totally.
And there's not a lot of spare capacity in the system. So all of a sudden, everything's stuck in the wrong location, and things are in the Philippines or Singapore or LA, and they need to be in China picking up the next load. There isn't enough slack to just say, okay, fine, sail them all back to China. Okay, that takes whatever, 3 or 4 days. I don't know how long that takes. And that during that time, everything's stacking up and getting worse and worse and worse.
Totally.
So people see rising prices and call it inflation. One of the things I've written a lot about is it's actually rising and falling prices. Falling at the source. People who produce stuff can't get paid hardly anything because the warehouses are overflowing with them, and the consumers are paying more because the supply chain, logistics chain, the freight carriers, the port in LA, infamously, nobody can, they can barely keep up like in normal times. Then you have this like shock, and then it takes months to work off. It's like, if you live in a major crowded area like New York or LA, and there's an accident on the highway, and of course, traffic comes to a standstill. You're driving home at 8:30 at night, and the traffic still has a wave that stops where the scene of the accident was
totally
8 hours ago, right? It's long been cleared, but traffic is a compression wave. And that compression wave doesn't work its way out until midnight or something, when finally the density of cars is too low to continue to sustain the wave.
Yeah.
And
so, and then on top of that, you get these longer term effects in decision making, which I'm really interested to watch how this stuff plays. I mean, after you go through a supply shock like this, maybe think about keeping a little more inventory around because the world is changing, or whatever the output of that thought process is. And so for these businesses that deal in physical goods that have to be shipped around, the downstream implications of that, especially with rates a little higher, like you got to finance that somehow, right? Like that storage isn't free. So you're either maybe you're borrowing but all, so the cost of money is going up at a time when business behavior is becoming a little more risk averse from a supply chain perspective. That is just horrible for P&Ls. I mean, it's really bad.
I saw, so Walmart had their earnings miss, and somebody posted a graph showing their inventory levels. And the graph of inventory levels, I guess, versus earnings went back to, I think, the 1980s, a long-term graph.
Yeah.
And inventory levels right now shot the moon. Like, unprecedented during the decades of this Walmart graph. And one person commented, I have no idea whether this is right or not, but it sort of rings true. Is that real inventory that has real value, or is that, how do we put it, stuff going obsolete fast and, trinkets and junk?
Right. There's scenarios where it could be a pure loss, if the product gets outdated. That's fascinating. The other thing that I love your example with the traffic, because, the way that you solve that is you have one car just sort of like slowly and methodically go forward to even out that ripple. Like there's this guy on YouTube who goes and he'll sort of like try to iron out these traffic things. And you basically have to leave a buffer in front of you. Cars are going in front of him. And that's kind of what these big retailers are doing with inventory, right? They're trying to sort of, they're acting as that buffer, but there's a cost associated with that. I mean, their incentive is basically, if Walmart can remain the place where people know to go because they have stuff, in theory, that's long-term good for the brand, and that's great. But they're going to absorb that price hit, and again, someone has to pay for it. There's a beauty to it in that, like, the private sector is trying to write this thing, but they're going to do it at a cost.
I was going to say, a lot of these guys, it isn't necessarily strategic forward thinking like that. Just like on the highway, it's very rare to see somebody who's going to be a good Samaritan and tries to even out.
Yes.
Most people are like jam and cut and
just making it worse.
What the retailers were doing, and I read a lot of the stories during the height of the supply chain crunch, I guess sort of as we were emerging from lockdown. So initially, nobody was going to the stores, obviously. So the stores were sitting on goods that they couldn't sell.
Yeah, right.
Which must have been some interesting losses that they suffered from that. And then during the height of, like, we're emerging, but the supply chain isn't delivering, they have all this inventory that's somewhere in the logistics chain, and then they need inventory to sell. So then they're like air shipping stuff, paying more for it, not necessarily making margin on it. But what that means is that they've bought double what they really needed for Christmas. And then eventually all those shipping containers will work their way through the system. And eventually then they end up with like a surplus of inventory. It could be a Walmart graph is showing that exact, dynamic, playing out. And the thing you always have to ask with a graph that ends with a vertical like that, does that continue, or is that going to level off at 32?
Yeah.
I don't know. I'm not sure anybody knows. Maybe the Walmart supply chain people know.
Yeah. Well, you have this, this inventory needs to be cleared either by losses or by consumers buying it. And the consumer, it's coming in, you have this happening at a time where the consumer is already under pressure. I mean, I thought one of the greatest earnings reports recently was the Restoration Hardware CEO, who I think, that was a month ago or something by now. He just read it out. He's like, look, this is an unbelievable environment. We either, every retailer I know, that earnings report that was one of the best things I've ever heard from a CEO on earnings. It was fantastic. You should go read it. He basically just came out and said, look, everybody I know in retail is faced with this dilemma where it's like, what are we going to do? Are we going to eat the loss here to try to preserve demand and preserve, brand loyalty? Or are we going to try to pay that forward to a customer who can't afford it? I mean, there's no real great outcome there. At some level, we're looking at a negative growth environment here, probably. I mean, what do you think we go? I mean, GDP coming in negative was pretty funny. Everybody's sort of in denial about that, but I don't know. It looks pretty bad.
Yeah, I don't know how this goes with leverage. How many of these sellers are zombies? Interest rates being hiked. One of the things I say this often, which is if one's only concerned with consumer prices, and one was either completely ignorant in the sense of like Dunning-Kruger effect ignorant, or recklessly, callously indifferent to all of the other harms caused by falling interest rates. But one only cared about consumer prices. One should want falling interest rates, not rising interest rates. So
That's what we've been doing.
Right now we have supply contraction, and obviously in energy and food and all the things that are exported by Ukraine and Russia. But you know, country by country, Indonesia, India, they're starting to announce bans on exports.
Yeah.
Right. So this starts to spread. In this environment, the producers who are still solvent, that are still, you know, they want to work to expand capacity because there's an opportunity to make money here, right? What do? We make it more difficult for them to obtain financing.
Yes.
And for those fewer of them who can obtain financing, we make it much more expensive than it used to be. And you think it's going to cure lower prices? There's going to be such a wreckage of suppliers destroyed in every market. And then we're going to say, oh, see inflation.
Yep.
And that was...
And then, you know, the fix ultimately, I mean, I think at some point here, we got to see them, you know, sort of essentially try to pancake rates to get all that going again, which is effectively, you know, that's kind of the bond thesis is at some point this causes enough damage that we got to restart all that appetite for CapEx in a really bruised up economy where like consumers bruised, businesses are. I don't see how you get persistently high rates from here.
No, I was going to say there's a term from computers and software, which is the term stateless, and that's the ideal API. You know, it's stateless. And I used to use the opposite term when I was a software developer, stateful. You know, things that have a memory. So you call the same function with some inputs, and you get a different answer because the function has a memory internal to it, knows what happened yesterday or whatever. Well, people are quite stateful.
Totally.
So you offer them the same, you know, interest rate or the same incentive today versus, you know, let's call it February 2020. They're not going to behave the same because they remember what happened.
Totally.
Businesses. So we're in this huge climate of uncertainty, regulatory uncertainty, tariff uncertainty, leaving aside war and all the uncertainty that creates. And, you know, and then you go and hike rates, go and destroy, decimate industries wholesale. Then you say, oh, no, you know, mistake. Sorry. We're going to go lower rates. Is that going to get the same effect that if you hadn't, you know, jacked them up in the first place? Obviously not. Yeah. And it's very hard to predict how and who, and there's always a new entrepreneur with fresh capital, or at least that's the theory, which, you know, kind of reminds me of Atlas Shrugged, when it's like, oh, Mr. Reardon, you know, how are you supposed to, you know, handle this latest new crushing burden that we're putting on your shoulders? You'll find a way. You always have.
Yeah.
You know, every time we destroy industries, you know, there's always a new investor coming in with new capital to buy up the old assets and restart it and hire people. And will that be true? I think there's a world of hurt coming for sure.
I think so too. I mean, you know, we tend to think of investors, we like personify them, right? Like the brave investor or whatever. But I think in aggregate, a lot of the investment recently, you listen to things like passive investing and all that, a lot of this is just sort of like, it's systemic investing, you know, like people drip their 401ks in, people, you know, 529 plans for their kids. There's just this systemic push toward assets. You know, the products get repackaged. People don't necessarily think of themselves as investing in assets, but they're in some target date fund or whatever. If we were to see people really get blown out on that stuff and see the appetite to deploy capital just decrease broadly, that's not great. that's you know, that creates lasting damage. It's one of the reasons why I'm so, you know, aggro on Twitter about Bitcoin, is I think there's a real danger in the whole retail revolution component of it. I think if people get really stung, like, it's, you know, I'm not against Gen Pop making gains trading. That's great. You know, go have your fun, get your gamble on. But, you know, it's a zero sum game at best. And as you and I have discussed, it's more likely a negative sum game.
Negative sum, absolutely.
And so if people get burned really hard by that and internalize this message of like deploying capital is risky, then it's not like it's not like that's a minor thing. I mean, if America sort of thinks like, yeah, you know, I'm going to raise my cash levels forever. That's a meaningful decrease in the amount of capital available for just everything, CapEx for entrepreneurship. It's just sort of society wide. And the more I look at where we're heading, the more I think there's a real risk there. And you couple that with some of the other dynamics in play, like, the boomers. I mean, for them, taking a loss is pretty bad because they're no longer out there in the economy really working, most of them. So I think you could get a real proper long-term decline in the amount of capital available for industry, entrepreneurship, all that.
Let me just tweak that slightly and say all that capital. I wrote an article years ago called The Credit Gradient, and this idea that even in normal times, of course, Fortune 500 companies with AAA credit ratings get a lot more credit, a lot cheaper than mom and pops and early stage companies.
Totally.
But when the government lowers the interest rate or sets in motion this dynamic, which causes 40 years of falling interest rates, and or what I didn't say in that article, but looking today with all the uncertainty from COVID, the uncertainty tilts. So you have this, think of this as a pool of liquidity, and the big companies are on the deep end to begin with. All you're doing is you're tilting it even more.
Yes.
And so, what is savings? Savings is like people keep dollars in a bank account. So it's not like it goes away,
right?
But it goes to the balance sheets of JP Morgan and Citi and
yes,
corporations who have less and less productive opportunities to do with it. Because if you're managing trillions of dollars, you can't really focus on the entrepreneurial and early stage end. You need to deploy. Obviously they have a team of asset managers there. A friend of mine who's in the asset management business was talking about somebody who wasn't nearly as big as JP Morgan or anybody like that. They said, their team, their average guy on their team, has to look after a portfolio of something like $500 million to $1 billion.
Yeah.
They can't be looking at 10, 20, 30, $50 million valuation startups.
No, it's wildly inefficient.
Opportunity is, and where all the value creation is.
Yeah.
And so they have to just be looking at, okay, we're going to buy real estate, we're going to buy S&P 500 companies. And so you get this over excess of capital on the companies who don't need it and don't have anything productive to do with it. And they get bloated, and the management teams find more creative ways to help themselves to that via bonuses. And
I mean, there's that dynamic exists at a number of levels. Another one is, when we were running our company, we took some debt along the way, and we were the amount we paid for that would sound absurd to most people who think about like business. I looked it up the other day. We were paying 11%, which is pretty spicy, right? But it was unsecured, and we're a startup. Like there's nothing. It's unsecured debt. So the way they underwrite that is they clip you for a small warrant, which helps de-risk the portfolio as a book, and then you're paying high interest rates, and they underwrite essentially your growth line. And for us, it felt like free money because we were growing at 300% a year. So it's like, it's better than equity capital. But I think that dynamic is really interesting. So for a small entrant, higher rates can be overcome by growth. And so when you have these higher rate dynamics, if you're a small business, those higher rates are actually a competitive edge against a massive incumbent, because a massive incumbent can't pay those kind of rates because they're just not as efficient. Like small startups are wildly efficient. I mean, to a level that's just sometimes pretty ruthless, very scrappy, all that stuff. And so you can pay these higher rates, and you're breaking into a market. There's just a lot of growth ahead of you. And when you get an economy in which there's just low rates everywhere, like these incumbents just come along, they see anybody vaguely competitive, they just buy them and take them out, or lower their prices and put them out of business. It's this very pro-monopoly kind of situation when you have persistent low rates. And it's really unfortunate because, I think America is really good at entrepreneurship. It's one of the things that it's one of our, it's the thing we value as a society. And so a lot of people like to give it a go. But it's just harder and harder for new entrants into the economy, whether that is a millennial trying to buy their first home or a small business, to compete with these huge entrenched incumbents when you have persistently low rates.
I would just reinforce that entrepreneurship component of American culture. I've traveled all around the world, both in the Anglosphere and other places, and in a lot of places, there's very much a sense of you shouldn't dare to try to rise above your station.
Totally.
And if somebody is trying to really go for the big brass ring and start a company that's going to become a multi-billion-dollar enterprise and change the world in some way, there's a fair degree of ill wishing and hoped for Schadenfreude. And if that company fails, that person's so while they're trying and while they looks like they're succeeding, there's you have to cut down the tall poppies, is how they would phrase it in a lot of places. And then if that guy should fail, there's hey, what the hell did you expect? You got what you deserved. You got what was coming to you.
Yeah.
And, I don't want to name countries and whatever. I have friends in most of these places who don't share that particular view, but that's pretty endemic out there. And in America, there's so many sayings. There's Michael Jordan saying, "I've missed more shots on goal than most people have taken."
Totally.
It's not how many times you fall down. It's that you have to get up one more time than you fell. There's so many things here that says, hey, look, even if you fail as an entrepreneur and your venture goes out of business, you learn something. Your next venture is going to be smarter. There is a next venture. There's this presumed optimism. Meanwhile, Of course, we're breaking that because we keep adding more and more regulations that make it harder and harder to raise capital. Obviously, every industry is increasingly licensed and regulated and controlled. You can't do anything. I've been tweeting now about this. Shortage.
Well, let's dig into that. I think you and I, this is probably an area where you and I would agree. I would say in some ways I'm a fan of regulation, and you would definitely say you're not. But I think in the end, we sort of mean similar things. So to my mind, regulation is the rules of the game, and there have to be rules and people should follow them. And what we're seeing now is regulation as regulatory capture, which is like the exact opposite of what you want from regulation. We're seeing regulation that further entrenches this advantage the incumbents dynamic, right? Makes it brutally hard for new entrants to pay some yearly licensing fee. Like all of the small players get washed out before they start to exist because you have this crushing, essentially burden of entrenched regulatory policies that doesn't really let any of that stuff bloom.
It doesn't allow your new model and the cost of compliance. You can't raise $3 million to put together your compliance program
totally
before you've really started producing revenue. And
so we simultaneously have too much and not enough regulation, right?
I was going to say, I'm a big believer in the rule of law. Like, it should be illegal to lie to take their money. It should be illegal to defraud people and cheat them and steal from them and these things.
I vaguely remember the rule of law.
But regulation is when they attempt to do a couple of things. One is guilty until proven innocent. So in regulated industry, you have to prove your innocence without there being any evidence of any actual crime. Number two, of course, regulation completely breaks down the separation of powers, right? So in the Constitution, and for people that are listening from abroad, there's several things that were unique about the American experiment, and one of which was separate government into three branches: the legislature who writes the laws, the judiciary who tries the cases and determines the fact of whether or not you broke that law, and then the executive, which enforces the law. Regulatory agency writes the law, judges the law, and enforces it. And so that, and of course, you're appealing to the person who wrote the regulation to say, please show me mercy, my lord. It is not the same thing as, the cops arresting.
Yeah, that's fair.
You're petitioning a court, which is presumed to be disinterested, and even a jury of your peers. You're petitioning the regulator themselves.
Yeah, and what you're describing here effectively flips the burden of proof, right? Which is the problem. And it's the dirtiest way to win an argument, and it is a piss poor way to legislate.
And then they have these vague statutes of what constitutes securities manipulation, for example. So there's been a lot of stuff that's gone on with Elon Musk, and even before this whole Twitter, I don't even know whether you call it adventure, debacle, I don't know what the word for it is, but long before that, this is 6 to 8 months ago, his brother sold some shares in Tesla.
Yeah.
And there were a lot of people arguing that should be illegal under the Securities Act that should be a required, disclosure that has to go through. Like everybody has to have a chance to front run his brother selling the shares, as if it was Elon himself. And I'm like, well, that's an interesting expansion of the powers of the regulator. What does that really, serve? So with regulation, you have non-objective law where it's impossible to know in advance whether something is illegal or whether something is legal. My favorite example for that, and I started to get into this whole thing around the time that there was the Microsoft trial, antitrust for bundling the browser with the operating system, at around the same time that there was the OJ trial, for the murder of Nicole Brown Simpson.
Yeah.
And I said, compare and contrast these two things. In the OJ trial, the controversy, there was no controversy as to whether or not it was illegal or should be illegal to beat and stab somebody to death. The entire controversy was over the fact of whether or not OJ did that to the deceased, which is how it should be. And it went to trial, and he was acquitted and whatever. In the Microsoft trial, there was no controversy over the facts. The fact is they bundled the browser with the operating system. The entire controversy was whether it was illegal or should be illegal, with PhD, JD, wonks weighing in as to their opinions of this. And clearly this is a major corporation. They had the advice of counsel. They didn't think that what they were doing was illegal at the time they did it. And then they have to go to court where it has to be determined whether it should be illegal. I mean, how do you run a business in an environment where you can't know in advance whether something is legal or illegal? So it creates uncertainty, and you get a hesitancy to invest. You get less innovation, a dearth of consumer products, fewer of them at higher prices.
So how do you think society should approach stuff like antitrust?
Well, it starts with, and I've tweeted a few times about this, to the extent that a company abuses its so-called market power, that is to the extent to which it actually reduces its market power. If you try to twist, if you try to nudge, I love that term from Cass Sunstein when he was selling Obamacare. If you try to nudge your customers, which means, force, strong arm, twist their arm, whatever, that is the extent to which all sorts of negative things are happening, that you're actually losing that power. And somebody might be in a position where they have no choice today, but people are stateful. So I don't actually believe in the whole monopoly theory of the left anyways, number one. And, in a free market, as long as someone else has the right to compete, not that the government manages and has some central planner defines for each market what's the right number of competitors, which is non-objective, and how do you define the market and what are the substitutes for the market anyway, and so on. There will always be the next thing if a company is abusing its customers. Now, what you find, the classic cases in history, Standard Oil, Alcoa Aluminum, to name two, were actually hated the most, and Microsoft for bundling the browser for that matter, hated the most, not because they were abusing their customers, but because they were always pushing themselves to deliver more to their customers, and their competitors are saying, hey, that's not fair to us. We need to have less for your customer at higher prices, so it gives us room, to compete. And it's like, well, who is this law supposed to be protecting? We've kind of lost the tune here.
So it's, to me, this thing always gets complex when you have a scenario like I think we have now, where there is a lot of like regulatory capture style dynamics, and those are the things which are protecting and entrenching monopolistic behavior. Like, I'd love to see that end.
That's right, and that should be the first step that we can all agree on.
But it's weird. The way we go about ending it is weird, to your point, which is like, we set up this situation where there's like regulatory capture, then people get mad about that, and then we go like smash the company, which is very weird. It reminds me of what we're doing now with in the macro, where it's like, well, we've got this really weird situation where there's sort of supply shocks and whatever else, and so our solution is, at a time where everyone's levered up, we're just going to crush demand. Like, that is just the worst possible way for us to get out of this thing.
I've tweeted a few times about there's a huge shortage of baby formula right now.
Yeah.
And, so it turns out when you look at it that the FDA has forced Abbott and Gerber at least to close plants. Now, why? Well, it gets into the abundance of caution, the 4 babies who got sick. No particular evidence actually linking them to Abbott food, but, plant closed. And the philosophy seems to be we'd rather have millions of babies starve than, take the risk that 4 babies who got sick.
I mean, you presume there's a philosophy guiding this.
Right. And anyway, so some congresswoman, decided something has to be done and appropriated. It was actually a tiny amount of money. It was only $28 million, which by the standards of our government today, you can't even get out of bed for $28 million anymore.
That's the change left on the dresser.
That's right. Appropriated $28 million to give to the FDA to hire more regulators.
Yeah.
I'm just like, we had a problem that there were too many regulators that were too overactive, shutting down plants and causing a shortage. And now we're going to hire more regulators. That'll fix it. And so every time, here's how I look at it. The regulation creates incredible perverse incentives. And then, of course, the companies that are subject to perverse incentives behave perversely. That's used to look at how these evil capitalists are behaving. We need more regulation because otherwise look how perverse they would be without regulation. And so then we create more regulation, and then there's more perverse incentives and more perverse behaviors and more perverse outcomes. And, if you don't stop it, you get all the way to Venezuela, at some point.
Yeah. These dynamics are really funny. There's a local business here who's building it's a gym, and they built sort of an outdoor expansion, and the fire department, they're like trying to put this thing up so they can, make it through COVID, because it's like people want to be outside a little more and wherever else. Fire department charged them like $7,000 to certify the thing, and it's an outdoors expansion. Like, what kind of fire risk are we talking about here? Like, just nothing to catch fire, right? You just walk that way. If there's a fire anywhere near the building, you're going to be fine. That type of stuff drives me.
You're outdoors.
Yes. Yeah, and it's a business that's trying to sort of like bob and weave in this very difficult environment, and the point, of course, is to preserve their ability to make money. And it's just sort of this like huge chunk. The $7,000 is like, it's just a lot of money out of nowhere. Right. Yeah, that stuff drives me bananas.
For companies, revenues have already been crushed. It's already dealing with all sorts of other problems.
And I think that one of the issues is there's no, like you look at that as an outsider and you're like, well, couldn't they just sort of look at that and make an exception and be like, look, you're fine. And I think the problem with the application of regulation a lot of times is that that's just not how it goes. It has to be this paint everything with the same brush kind of approach. And when you do that, you directly reduce human dynamism because you're not responding to the situation.
Well, wait a minute, they do create exceptions, but the exceptions are created for their cronies.
Fair enough.
So if you have the rule of law, you need a consistent application, equal protection and all that. If the law is such that you have to constantly make exceptions for it, I would suggest you got to reconsider that law. Like if there was a law against murder, nobody would ever argue for any exceptions.
Yeah.
Law against rape, a law against burning somebody's store down. There shouldn't be any exceptions. Yeah, if you do those things, you go to prison. But law against building an outdoor. I'm going to guess that not only was it outdoor, but it was concrete and steel. There wasn't actually anything flammable there anyway.
It was steel. It was all steel.
Right.
There's nothing flammable, and the building's brick. I'm like, what are we?
Right.
And simultaneously, I understand that, like, let's say you're doing new construction, maybe you do have to have them certify it. I don't know, once or something, right? Like, I think we don't want people burning in buildings that were poorly designed, surely, but like, this isn't that situation.
Right.
Yeah.
So let's turn to Bitcoin. I was going to say Bitcoin and crypto. One of the memes that's floating around there right now is that Bitcoin is not crypto. Crypto is something else. And every time the Bitcoiners try to differentiate themselves from what they call the quote unquote shit coins, I like to post, there's a Dilbert strip that Dilbert goes to. I don't know if you ever seen me post this, Travis. Dilbert goes to Dogbert and he says, "What you doing, Dogbert?" And Dogbert says, "I'm writing press releases for fake green energy scams. Here, listen to this. By 2030, scientists predict that you'll be able to power your home from the breeze with the breeze from your refrigerator door." And Dilbert goes, "Oh, great. Now how am I supposed to tell the real ones from the fake ones?" And Dogbert looks up at him and he goes, "This is the best part. I mean, it's already funny, but the best part," he goes, "Seriously, you think they're real ones?"
Yeah, totally.
So Bitcoin,
yeah, I mean,
it's not crypto, it's not shitcoins. Bitcoin is something completely other. It's a real green energy, thing, and not a scam.
I mean, it's the deepest irony of the entire crypto thing is that they fancy themselves Austrians, a lot of them, which I find so funny because it is the most woeful capital misallocation I've ever seen ever. These guys were there's racks of these ASICs, just like tons of silicon. At the time where there's a chip shortage, they're putting them in warehouses, which they then spend a bunch of energy to run and cool. And it's like, it's literally just waste. I mean,
it's funny calling themselves
so
absurd. A big theme of mine is that even if somebody agrees with you on the conclusion and argues for something that you like, but if the argument is total rubbish, you should, in fact, you almost have a moral duty to stand up and say this is rubbish. So there was a guy yesterday, I was sort of shit posting late last night as I was working on the document, and in between revising the document, I was going back and forth. And this guy says that, the price of Bitcoin is set by the hodlers. And I said,
I saw that one.
That is literally how prices are not set.
Yes.
I was tempted to say, hey, Austrians that are on board the Bitcoin thing, is there anybody that would you care to school your, fellow traveler? And I was like, I'm not going to go that far. I'm not going to say that. But that's exactly how prices aren't set. But that's how the Marxists and all the other people think that prices are set.
Well, this is again the great irony here. Bitcoin it's a variant of Marxism, which I find just it's mind-numbing that it's marketed as
they have a theory of value.
It's a whole host of it. I mean, you think about I did some labor, and therefore I should be able to hold that for all eternity, and it should increase this one thing that I did, which I traded for money. I should be able to then snowball that value forward forever. That's ridiculous. I mean, a human economy cannot work like that. It's just patently absurd. And you have all these people believing it. It's truly amazing. There's that piece of it. And then there is this piece where the entire store of value thing is just really just kind of a trip. Because if you were to think about a store of value in the essence, like if you make a perfect store of value, it would mean that thing, this one unit, is now pinned to all other prices, right? Forward in time. So that thing can forever buy X loaves of bread or whatever. Well, great. You just killed markets. That is literally, you're describing price fixing. It's like, it is not a goal.
Deal that wheat should be this and shoes should be this and the ratio should be fixed at all times. So
yeah, like that. Great, Stalin. Good work.
I'm working on a paper looking at the term is anti-concepts. These are rationally unusable terms that have been
love that.
In some way. I'm going to coin this term. And one of the anti-concepts that I delve into is store of value, and that all of the rhetoric, it's a lot like crypto or Bitcoin, where they use rhetoric like coin and mining. They use all these terms that evoke something that really have nothing whatsoever to do with the reality, but they're just really great branding. So this idea of store of value evokes this picture of container, like a water jug, and you pour water into it, and then as long as you put the stopper on it, it should hold the water in theory forever. And then when you're ready, you unscrew the top and you pour the water out, and it's good indefinitely. And that's not how even gold works. When the gold people say store of value, but there's in the store, and then other language that use retention or retain. It's like a retaining wall. Like you have like wet silt that wants to ooze down the hill, and then you put up this barrier that But what is it you're trying to capture? You're trying to capture. Well, of course, you have the Michael Saylors who say it's pure digital energy, man.
I can't even engage with that.
And of course, if you try to take your Bitcoin container, you're not going to get any oil out of it, or nat gas or whatever form of energy, but ultimately labor. But it did this work, and now the work is encapsulated in this thing. And so, Dixon, did you want to put up some tweets? And
well, I think this was one that y'all were kind of riffing on, just the whole energy dynamic. I mean, Travis, you said you just can't engage with it. It looks like you did engage with it a little bit.
Yeah. I mean, I should rephrase. I engage with it all the time, just not in a serious manner. I mean, that I sort of like, I kind of feel for people who get bound up in these ideas a little bit. I think it happens to all of us at various levels. Like, you have to constantly be on the watch for sort of these, these really custom designed memetic warfare ideas that get thrown at us. The internet has made people very good at marketing and branding because it's this constant sort of cycling lab. And I'm always fascinated to find people like you, Keith, who don't, like you're in the gold business and you're sitting here saying, look, the store value thing is not the way to frame this. I just love that. Like, it's so rare to find to be able to engage with people who are not taking the bait on a concept that would serve them, because the concept is wrong.
So, I don't know if we knew each other, or if you followed my work way back when. I made a lot of enemies in the gold community. Particularly, I mean, it wasn't even the store of value thing. I guess the first set of enemies I created when I said fractional reserve isn't the problem, it's duration mismatch. But then later, the biggest meme in the gold community is manipulation.
Right.
That's conspiracy.
Yes. Right? This is how I found you. Brent turned me on to that piece. It's a great piece.
There's this vast conspiracy that over a period of decades is holding the price of gold thousands or tens of thousands of dollars below where it should be for decades. And, given the number of banks that are involved, and every bank would have their trading desks and internal audit and external audit and regulate, there'd be thousands of people, if not tens of thousands of people, that would be aware of this highly illegal, fraudulent scheme, which somehow, there's no hide nor hair of, other than the London Whisperer, or whatever his name was. Anyways, I would take that on and say, you're not doing gold any favors by promoting this rubbish. There's a lot of good reasons to buy gold, and happy to talk about them, but this is rubbish. And people like Turd Ferguson, whose real name is Craig Hemke, Max Kaiser actually dropped the F-bomb on my name on his show. This is a decade ago, whatever. Because
if Max Kaiser's not attacking you, you're doing something wrong.
That's right. Because he said buy silver to crash JP Morgan.
Yeah. Jeez.
I said there's two problems with this thesis. One, buying silver is not going to crash JP Morgan. You've got the whole thing fundamentally wrong. And number two, nobody in their right mind should want to crash JP Morgan.
Yes, exactly.
Even if you think that the banking system is problematic, you should be looking for a graceful transition to something better and not the calamity of that. Anyway, so he decided I was his enemy and actually was cursing at me. And so I made a lot of enemies doing that. But I think it's a really important principle that if your friends are making a rubbish argument nominally in support of the thing that you agree on, they're actually undermining it.
I totally agree with that. There's this whole thing, the false dichotomy gets thrown around in finance. Do you want to be right or do you want to make money? I'm like, well, I want to be right for the right reasons. And I trust that in the fullness of time, that will work out.
That's right. And they're just saying, no, just go all into Bitcoin because it's going up. Or it was going up. Obviously, that dynamic has been broken. Yeah. Down 5% as of this morning.
But here's one. So I think in the beginning, Travis, you talked about just the importance of balance sheets. And I realize you're quoting another person's thread here, but I'm actually going to read this just because, we've got some listeners who will only be listening to the audio. So just for their sake, let me I'll read the tweet and then I'll read the quoted tweet and then I'll read what Travis says. So Travis quotes conclusion, both bank issued money and Bitcoin is written into existence. The latter, though, requires huge amounts of energy before that creation from nothing occurs, and the thing created has no liability side. In fact, it's simply a numerical noun. And then Travis tweets, excellent thread, and agreed. The great irony of Bitcoin is that it is, in fact, purely unbacked in a way that fiat is not, because of a basic failure to understand balance sheets and money as epiphenomenal thereof.
Yeah. I mean, sometimes I just get real deep in the big words. Yeah. So I think the thing, if you want to understand finance, just get deep into balance sheets, because you learn, some of the stuff that really kind of blew my mind when I went down that route is, saving and debt are kind of the same. Like they're two sides of the same thing, right? Because if I'm going to take my money, I'm going to save it somewhere. So you can do that one of two ways. You can either have a bearer instrument, which is, again, one of the reasons gold is interesting. You can sort of, save yourself. But even then, if you just sort of run with this balance sheet thing to get into the mindset of the world as balance sheets, you have a safe in your house, and that safe has a balance sheet. And if you put $1,000 of gold in there, it owes you that gold in some sense, right? If we're going with everything is balance sheets, and all of this stuff breaks down into.
You're really getting philosophical.
Well, yes. I mean, I just think it's like it's informative to take an almost absolutist framing to this stuff, right? Because even then, like whether you're storing your gold with someone like you all, or whether you're storing your gold in your safe, there's a carry cost associated with that. Like you got to pay the rent, you got to pay property taxes. There's a cost, and so all of these, understanding these really basic fundamentals like balance sheets, P&Ls, that will help disambiguate some of the horse shit that you see online, right? And so when you think about this, is one of my favorite sort of things to say over and over here is that I think part of what's going on with crypto is that it's essentially this little, the number go up phenomena is essentially because they've created a little pocket Weimar Republic here, right? So you've created, if you imagine crypto as a country, and it's a country that doesn't have any borders, it just exists, in the metaverse. Within that country, the central bank has gone insane and is printing a lot of money, right? And you're seeing the prices of things within that country, which are crypto tokens, moon. But the phenomena that people are experiencing there is like being in Germany and seeing bread moon and think bread is a good investment. Like that just doesn't quite work. What's happening is that there is a bunch of funny money being created inside of an ecosystem, and there are dynamics resulting from that. And some people will be able to get their money out of there, maybe, right? But like that is not an ecosystem that you want to engage with. And if you start trying to model this stuff out in terms of balance sheets, that is the kind of stuff that that's how you peel back the layers of that onion. I mean, when you are Bitcoin, if you buy Bitcoin, there is a sense in which you are giving money that you expect to get back out later to people who you have no idea who they are. It's a network of totally unaccredited, and they may be accredited, we have no idea. So you have to presume they're not totally unaccredited people. You're putting that money in there and you're expecting to be able to withdraw it later. That's insane.
I was going to say there's another fundamental error there, and that is this idea of putting money in withdrawing.
Yeah.
What they gloss over is that you didn't put anything. You gave your money to the previous guy who's exiting.
Yes.
So he's actually leaving the movie theater, and you've given him your money to get his ticket stub, because now you may think of it as getting your money back later with interest or whatever, but actually the next guy is going to give you even more of his money. Maybe, you hope. Yeah. And then,
I mean, it's a freaking Ponzi scheme. And this is the thing that's so funny is that it is a self-aware Ponzi scheme. You had Sam Bankman-Fried go on Odd Lots with Weisenthal and describe this, like you put the money in a box, take more money out, and if people adopt the box, then you're banking that more people will adopt the box. So, and Matt Levine's like, you're literally describing a Ponzi scheme. It's just This is
That's
a
right.
series of networked Ponzi schemes. Everyone's like, well, the safety is in diversification. I'm like, no, the safety is not in diversification.
No.
If you're diversifying Ponzi schemes.
This was one of my favorite. this image here.
Totally. Ponzi schemes, but network for safety. Like, it's just absurd.
To bring it full circle and to continue with the movie theater analogy, you said, do you want to be right or do you want to make money?
Yeah.
In order to make money, you have to get out the exit door of the movie theater. Except all the exit doors are chain shut except for one, which is only half width. And there's a crowd of 1 million people. When the movie theater is on fire and it's time to rush for the exit, there's 1 million people rushing for that exit. And you think that I'm going to be one of the first ones to get out the door. Maybe you will be. Maybe.
I mean, this is one of the downsides of American optimism, right? It's that we're really good at bubbles because we always think we're going to be the first ones out the door.
There was actually a meme that circled, I think, on Twitter where I heard several people say, I'm long like short duration Ponzi's and short late duration Ponzi's, meaning I'm taking the position that I'm going to be early enough to get out in time, but I'm shorting, the people that are going to get out late. But
I'm a simple guy. I think maybe you just own productive assets, which, I mean, you all are effectively in the business of turning gold into a productive asset, right?
That's the key distinction. And I it's funny, I make enemies with this one too. I define speculation as buying an asset and, later to sell. And the profit to the speculator comes from the savings or the wealth or the capital of the next speculator.
Yeah.
Investment is financing a productive activity. The profit to the investor comes from the profit on that production.
Yes. It's very rewarding too. Like, it's fun.
Nobody's making more or new or at least an increased quantity of consumer goods or maybe producer goods, is selling those at a profit and is paying the investor part of that profit for the privilege of having had that investor's capital, whether it's equity or debt or whatever. And so fundamentally, speculation and investment are opposites economically, although in a world where the Fed has deprived investment of most of its return, we'll turn to speculation as like a surrogate in the way that caffeine and then jolt and then cocaine is a surrogate for sleep.
Totally.
By the way, it makes you feel euphoric while it kills you.
Yeah. Here we are.
Well, this has been awesome.
This is fantastic. Thanks for having me on.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.